Morning. My name is Len Gillette. I'm the president of the Silicon Valley chapter of AAII, and I'm welcoming you to our January 14th meeting that'll focus on the economy, investing, and real estate. I'd like to just start off by making a couple of comments. I'm really glad we're all at home instead of driving to a program today because the weather's quite unsettling. We have a large group today, so individual vocal questions will not really work very well. So if you have a question for the speaker, just type that into the chat. It's down in the center of the bottom of your screen in most cases, and just type in your question and we will feed those questions to our speaker. Also, I'd like to ask for if anybody'd like to volunteer to help us out in running this chapter. We could sure use some people to help us find speakers, coordinate with them, and do some of the video editing and other management. And you can do that by becoming a member of our board or by just volunteering. We have people that just volunteer for specific tasks, and that's really welcome. Also, comments about the recording of the program will be recorded. That should be available roughly a week after the program is concluded today, and those are on YouTube. And the next comment is our next program will be in March. It will be March 11th. There'll be no February program. And I'm going to go right into the introduction at this point. We're very pleased to have Kristina Kuprina as our speaker today. She is the president of First Sequoia Wealth Advisors. Her topic is the economy and how to manage wealth in 2023. She's worked in this area for quite a few years, and read a little bit of her bio. Her highest intent or objective is service to her clients, their families, and communities. She founded Sequoia Wealth Advisors to help others achieve financial stability, conscious and awareness and understanding of how the financial markets work and how they could serve them in their lives. She enjoys using her financial expertise to be of service to her clients in providing clear, direct communications and establishing long-term relationships with them and helping them with their finances. A couple of the topics that will be covered are tax optimization, investment considerations based on goals rather than just market conditions, and connecting your investments and strategies to the rest of your life. My objective was to really have a summary to get us launched into the new year and talk about the market that we're in. And so we're going to turn the mic over to Kristina. Go ahead.
Oh, thank you, everyone. And I want to say thank you very much for your willingness to spend your valuable weekend time listening to me talk. I am very passionate about the subjects of financial planning and economics. And so sometimes you may hear me get very excited about things. My highest intention today is each and every one of you that are participating finds value in the information that I share with you today. So please, please, please ask questions, ask them in real time to the moderators, because I will adjust today's presentation for the areas that are most interested to you. This is not a hard pre-planned presentation. There are topics I'll be covering, but I'm very, very flexible to take you in the direction that's most important and valuable to you. So please ask the questions. I'll take pauses throughout the presentation to answer them. And so it doesn't all have to wait till the end. And I'm perfectly fine with, again, pivoting to the areas that are most interesting to you. Just a brief, a bit about my background, just, to add to what Lynn said. My background is I've been in financial planning and economics for well over 30 years. I'm trained as an economist. And I've been doing financial planning. Sequoia was founded in 2007 with the idea of creating a better financial services firm. We have no products for sale. We are paid a fee for service, which makes it fun because each and every client has different needs and each and every individual has different objectives in that stage of their life. So if someone says, I just want to do some tax planning, I have no incentive to say, oh, I have to manage your investments too. It gives it a tremendous amount of freedom and again, makes the job fun. financial planning and investment management is an area that probably not so much for this group, but for many people is an area that's stressful. And there's a lot of considerations that go into it. And so with that being said, I'll jump in. I want to give you just a little bit about me. The highest intention again today is that each and every one of you get value from today's presentation. The other thing I wanted to be sure to offer is that if additional questions come up after this presentation, I am more than happy to answer them. You do not have to use our services. You can simply respond in an email, which you'll be able to get from the monitors, and say, I was on this presentation and I have some more questions for you, and I will answer them. So I wanted to make sure that you know this extends beyond just this presentation today, especially for those of you that are receiving the recording and will be hearing this later. So without further ado, the areas that I was looking to cover today was kind of a broad overview on the economy. There are a lot of moving parts here. And again, different areas will be of interest to different people. So please ask questions. I'll talk a bit about the Secure 2.0 Act, which is the recent legislation passed that has really big changes to many people's financial planning, retirement planning, et cetera. There is a lot in it. So I'm going to touch a very high level. So if anything I mention is that, oh, I want to learn more about that, please ask questions. Because again, if I just talked about that, it would take up the entirety of the hour. And finally, I'll talk a bit about financial planning and some considerations to make not only for 2023, but also in your overall planning, wherever you may be, whether you haven't done a plan yet or you already have an active financial plan, just some considerations and ways of thinking about these things. The other thing I wanted to say on that is each and every one of you are on a different path. So it's very difficult to give broad generalized advice. What is a great idea for one could be a terrible idea for someone else. So when you hear me sometimes being a little ambiguous about the best course of action, it is simply because I don't know you and your situation well enough to make recommendations. Again, follow up with questions on this, and I'll do my very best to get you the information that you need. Before I start, is there any questions or topics or anything I said so far that someone's like, hey, wait?
Nothing so far.
Okay. So with the economy, we'll start with that. With the caveat that I have a pretty dang good track record at forecasting. Don't always get it right for sure. But that being said, in my entirety of my career, there's never been this much variation of possible outcomes in the next year. Never in my career have I had that. Everything from a severe recession on down to a very soft landing. And all of this is validated and supported by data. That's where it gets challenging. Why is this the case? Because the market is entirely manipulated at this point by the Federal Reserve. And I just want to stress, I don't use the word manipulation lightly. I'm not trying to come across as a conspiracy theory. It is simply that the economic data is completely secondary to the Federal Reserve and their actions as they work to control inflation. And I'll give an example. When we have S&P earnings higher in 22 than 23, normally the markets would be higher, but they weren't. The Fed's actions are more powerful than underlying economic data. And the Fed's actions will have impacts that are unknowable at this time. I'll give you the highest probabilities, and I'll also say how this could change or what you want to watch for in this. My presentation at the end of this month to another organization is called What to Expect When You're Expecting a Recession. So pretty much at this point, everyone's expecting the recession. It's in the news, it's substantiated by a lot of factors, the expectation. And what I'd like to say on that is there is a reasonable probability that we will experience a recession, likely very late this year or early next year. But what exactly does that mean? First off, I'll talk about what it means at a high level, but then also at an individual level. At this point, the highest probability is the recession will be relatively mild and short-lived, which means there will be companies and sectors and areas that will actually get through it pretty dang well and even grow. There will also be a lack of correlation. So for example, an area that's currently in recession is single-family housing starts. I won't go too much into real estate today because I know you have a presenter after me that will be talking about that, probably more expertise in the details than I have. But the single-family housing starts is in a recession right now. It will also be the first area to pop out as the rest of the economy is potentially heading that direction. So different sectors and different areas of the economy are going to follow a different path. Some will be stable, some will decline, and some will actually rise. So as individual investors, forecasting this is difficult because, again, variations that could happen, but there's some pretty high probabilities of the sectors and areas that will likely do well. And the important thing is to adjust that based on earnings, based on actual data, based on what the companies are saying. As individual investors, a consideration is know what you own. Strategies that worked well in the last few years are not going to be what works well going forward. Sectors and companies that have done very well in the past are not going to be the ones doing well for the foreseeable future. So a lot of strategy review is going to be very important here, and the tactical ability to adjust as we go through the cycle. So when looking at your portfolio, again, high level, I'll get into details in a moment, is really knowing what you own and is this the right thing to have in this environment. A big factor that goes into that is what exactly is it that you're looking to accomplish. So some of you have one portfolio, many of you have multiple portfolios. Each of those portfolios should have a very specific goal and objective. And with that, you can best strategize. So maybe perhaps in some portfolios, preservation is more important. That would be a very different strategy in this environment than opportunistic long-term investing strategies. Sometimes it's prudent to get off a slower moving bus, even if you really love the company or sector, and for a period of time, go on a faster moving bus. That's the tactical shifts. Again, none of this is specific advice. This is just general considerations because of the dispersion right now and how individual companies are doing and even sectors are doing. It's very important to be mindful of this. The set it and forget it by the S&P strategy is not likely going to be as successful going forward as having a lot of thought into the decisions you're making. Each individual portfolio, again, has a specific goal in your life, and identifying what that is and structuring it accordingly is the highest probability of success here. So I wanted to talk about that. So a recession is not a big boogeyman. A recession provides opportunity to both reevaluate, to make sure that your strategy is in line with your goals. It's also an opportunity to potentially buy things at very attractive prices for potential future returns. It's another opportunity, which, again, I apologize if this is information you already know. For the first time in over 12 years, fixed income is looking pretty juicy. And I'm not talking about the highly risky, speculative leverage stuff that people were seeking out in recent years because yield was just non-existent. Really pretty conservative rates are providing very attractive returns. And this could be a really good benefit. Whether you're trying to be a little more conservative for now, hold some dry powder for opportunity in the future, or if in your financial plan, you're kind of shifting your buckets around. So for the first time now, you can actually get some attractive returns in the more stable areas. Now, tread carefully here, because there's also a lot of risk out there. This is an area that you really want to know what you own, because if certain sectors go into recession or certain companies are more affected than others, you could see the default risk go up, right? So you really want to know what you own. The other consideration is the Fed is likely to continue to raise at least through the beginning of the year. That's their statement. That's not my opinion. That's their statement. They have made it very clear that they will adjust what they do based on economic conditions. They bring this up in every single meeting. However, the Fed's primary focus right now is controlling inflation. Their secondary and much lower secondary is the market and the economy. They're willing, and they've made it clear, to drive both the economy and the markets down to achieve the goal of moderating inflation. It is unlikely anytime soon they're going to get anywhere close to their 2% target. A possibility that they will accept a higher inflation number if they feel it's controlled and the economy is suffering. So they're going to be continuously making balances here. What does that mean to you as investors? Be nimble in your fixed income and be very thoughtful in it, because you want to be able to capture rising yields, but you also at the same time don't want to lock things up if conditions change. It is likely as this year progresses, you would shift potentially from shorter duration into intermediate duration, even long duration as the cycle unfolds. So nimble is going to be really key if you're looking for total return. If you're looking for income, a really big consideration there is going to be tax treatment. I would imagine most, if not all of you, are in the glorious state of California. I guess I should just reference here, we have offices in California and Nevada. And I'm working in the Nevada location today. So that's why I said the glorious state of California. And that being said, taxes are a big deal. So it's not what you make, it's what you keep. And so when you can find tax advantaged investments that make sense in your specific strategy, your true yield could be much higher, even if the listed yield is lower. So it's not always about the highest income, the highest yield. It's also about what are you keeping in the end. And this again will very much depend. Is this in a retirement account? Is this a non-retirement account? What is your tax bracket? A lot of factors go into this. I know I've been talking at length on the fixed income space, but I can't tell you how excited I am at the opportunities it's presenting right now. But it is an area that's a lot more complicated for investors than equity investing. It's a lot more difficult to sometimes navigate that space. And in doing so, like I said, if you have questions for me, let me know. If not, just be mindful, it's a little different animal than the equity investing. In the equity space, as I mentioned earlier, it's going to be really different. Some companies will navigate this period of time. The highest probability will happen really well. Other companies are going to be very challenged. For an example, and I'm saying broad-based sectors here, so understand individual companies may exceed this or do worse. The technology sector is going to be hit for the foreseeable future, collectively as a sector. The reasoning for this is that all of the big tailwinds that they've had in recent years, the sector's had in recent years, are now becoming massive headwinds. And you're hearing this if you are paying attention to, economic reports, earnings reports and company guidance. And they're saying, we hired too many people. Our spending is too high. We have to cut back. For the first time, really since the dot-com period, the technology sector is having a big reckoning. And a lot of technology is innovation, right? So a lot of money is put forward towards the future, to innovation, to capture the market, to this new technology. And so that has a lot of capital cost, So when companies have to rethink, we hired too many people, or we need to cut back on expenses, how they allocate that money, if they're becoming too defensive, could also potentially slow down their innovation cycle. Now, that does not by any means say don't invest in technology. Good heavens, look what we're all doing right now. Technology is a part of our lives. We will continue to innovate. There is some fascinating innovation taking place, especially in the medical sector around technology. The way that we receive healthcare and the way that we're treated for conditions or diseases, proactively or reactively, is going to fundamentally change in the next 8 to 10 years. Fundamentally change. There's a tremendous opportunity there. I would say likely greater opportunity there than on your traditional internet-based technology sectors. Now, not all of this will be successful. So as an investor, you'll decide, do I want to go with the more secure areas of the sector, or do I want to have some more innovation, really hot ideas, or a combination of those things? But the big changes are likely going to be in this sector. It is also something that is largely bipartisan, which means it's not as affected by the political winds in Washington. And what person out there doesn't want a better level of healthcare, better healthcare outcomes, better treatments, better survival rates? This is a pretty universal thing, and there'll be a lot of flows towards this space. So that was probably the big one. In the economy this year, the first half is going to slightly slow down a bit. This is collectively again. The second half is when things will start to stabilize and potentially drop. I can't stress enough that some very, very highly regarded economists with good track records are really diverged in their guidance right now and their thoughts towards it. Some are saying it's a recession's inevitable, it's going to happen. And others are saying, not so sure, maybe only 30% chance. Again, well-regarded economists with good track records. The reason is the uncertainty around the effects of the Federal Reserve's policy on the broader economy and our ability to navigate this space, right? And companies' ability to navigate this space. As inflation starts to moderate, the next issue is going to be, again, slowing consumer demand. So where we've seen this now, when the Fed aggressively raises interest rates at a historically massive, torrid rate, the impacts are usually felt in the lending areas, right? Where is this impacting people? It's impacting people holding variable debt. It's impacting the real estate market. And just as a reference point on the real estate market, if you got a 30-year fixed mortgage a year ago, you know, you got 30-year fixed mortgage on your average price home. Your mortgage payments, if you did the same thing now, are 40 to 60% higher. So you talk about affordability. Think about the impact that that has, right? So the house could be the same price, but it's costing you 40 to 60% more in those monthly mortgage payments to buy the same house. So what does that do? People who are already in their home and have debt, mortgage and debt, are much less likely to move unless they absolutely need to. Why would you refinance a mortgage at 2%, 3% into a 7% or more, right? It just financially doesn't make sense. So that cooling off the costs of real estate affect a lot of other sectors as well, because it is some of it is real. Yes, really, I'm paying this money every month. Some of it is also the wealth effect. If I'm spending more on my housing, I'm spending less in other areas. And the consumer drives the US economy at 68%. So when the consumer, either out of fear of a recession or turned down, or they're in the tech sector and like, oh, I might lose my job, or I'm not going to get my bonuses or my stock or something like that, tend to pull back. And that has a more meaningful impact on the economy than a lot of other things that we often hear about, like government policy and things like that. So I bring this up as just an example. It's not always the economy, sometimes it's specific sectors. So what the Federal Reserve has done is really affecting lending. It's affecting cash flows in households, especially households with variable debt. We're already seeing the effects at the lower end of the socioeconomic strata. People that are on lower incomes are more squeezed at this point because it's having more of an impact. That will eventually start creeping its way up. And that's a thing to look at. So the real estate sector, the impact is impacting, of course, a lot of other areas of the economy, because think about when someone buys a house or sells a house, there's a lot of other ancillary costs involved with that feed throughout the economy. I would expect, and again, I'm going to defer this to the real estate expert later. I'm speaking purely as an economist, and nothing in my titling says I'm a real estate expert. But consideration with this is going to be that it is unlikely to see a meaningful recovery in the housing market this year, because this will take time to play out. We're going to have to see the Fed get to cutting, and the Fed is unlikely to start cutting this year unless the economy drops precipitously. So this is going to be a longer game. However, single family starts will likely start coming out of the recession at the end of this year. So what leads into a recession also tends to lead out. Not always, there's a lot of variables there, but these are things to watch. If what led us into the recession is starting to recover, likely in the fourth quarter, then that could potentially provide opportunity for targeting other areas and sectors if your strategy is to invest long-term, buy at maybe more attractive prices. So that, again, kind of jumping around into different areas here. I'm going to take a pause for a moment. I'll talk a bit more about the economy, but I just want to see if there's any questions yet.
There's one question about the Secure Act, which I think you're going to be talking about later, but does the Secure Act allow the creation of one charitable remainder trust in which one can add money over time and even real estate into a charitable remainder trust?
I will talk about that in a moment, but I'll give you a quick short answer. Yes, but it's generally not worth it when you look at all the details. So and again, I can't give specific advice, but it may not, even if you can do it, it may not be the best way of actually funding a charitable remainder trust. But yes, I'll cover that in a moment in more detail, because I think there'll be even more questions on that. Are there any questions that anyone has around the economy? Just wanted to.
There is one question. Can you comment on rental markets?
Oh, I can, but I'm not sure what the specific question is.
Okay.
So I'll talk about a high level, and if the person who asked the question wants to ask more specific questions, please add them. So again, speaking as an economist and not as a real estate expert, we have a big issue with housing is supply and demand. We simply do not have enough housing, and I'm talking in millions of units. We do not have enough housing for the population. So that is actually what's going to put a floor under a more meaningful potential real estate decline of, say, 5 to 10%, depending on the markets, right? And again, could be more or less depending on the market. As any real estate person will tell you, location, location, location. But collectively, we don't have enough supply for the demand. And I say collectively, I'm going to talk about Silicon Valley in a moment because it's a little bit different. And because of that, it really does put a floor on rents. Only in the time in which rents are not affordable would you start to see those decline. That's kind of like the high level in it. And so the expectation of it is that rental markets are going to be hot, as in reasonably stable with a minor decline, especially in certain markets, because of the supply demand issue. When I want to touch upon the supply demand issue, because all markets are not created equal, San Francisco is going to be suffering for the foreseeable future. That really, San Francisco, there's no end in sight to the pain. It's a combination of a lot of companies moving out of the area, a lot of people moving out of the area for a lot of reasons, quality of life, affordability, et cetera, and having more office space and more residential space than is needed. So San Francisco will need to make meaningful changes to attract the talent back into the city. And so that market is going to be more impacted than some of the markets that people are moving to. I can speak for Nevada. It seems like it's all Californians. There's a lot of people moving. Why Nevada? And this is, I'm not trying to sell anyone on moving or changing states. California has glorious weather, and there's a lot of reasons to be there. But Nevada doesn't tax Social Security. Nevada doesn't tax your retirement distributions. They don't tax your pensions. A lot of our clients in Nevada are actually former California government workers, firefighters, teachers, police officers, et cetera, because your money goes further when there's less taxes. It's also lower cost of living for the most part. Now, it does have a different weather, does have a lot of different, there's a lot of variables in there. So you never want to pick a state just because of the financial reason. There's a lot more that goes into it. You actually have to want to live there. But that's an example of that, where people are moving. People are moving not only because of the increased ability of remote work, but also we have a massive wave of people retiring. So 10,000 people a day turn 65. Right. In addition to that, a lot of people have taken earlier retirement. The pandemic really threw a lot of people for a loop, and a lot of people just said, I'm done, which is a big part of why we had a lot of the issues with the labor market. And that's not going away, just as a demographic thing. And people, when they retire or when they're no longer connected to a specific area for their income, that's the time they say, I want to be closer to my kids. I want to be in a different climate. I want to be in a low cost or low tax area. And that movement around is meaning that previous hot markets are going to cool a bit as people are shifting around just because of the demographics. So please, with my big caveat there, is that you definitely, if you want to get deeper into rental markets and specific potential investments, it's really important to work with somebody very knowledgeable about the type of property you're investing in, as well as the market, because it is very variable and also depends very much on what your goals are. Are you looking for appreciation in value? Are you looking for a steady source of income? A lot of different variables that go there. I will touch upon the labor market here for a moment, because this also does affect rentals and whatnot. During the pandemic, we pretty much shut the door to immigration, legal and illegal immigration, which is a big part of our workforce. Regardless of where you stand on the issue, immigration is a big part of our workforce. The US is not replacing our population, domestically, as quickly as we need to. And as you know, we need a lot of young people paying into the system, so it works for the older people. And so in the past, we've filled that gap with immigration. So when we have this big demographic tsunami of people retiring, not paying into the system, and we don't have the new people coming in either through birth rates or through immigration, then you have the shortage of workers that we had. Now, there was other factors that went into it. A lot of people that were working in lower skilled jobs took the time during the pandemic when they're getting checks to better their education, look at other career options. There was a lot of shift when people said, hey, I don't really want to do this anymore. I've got the time. I'm going to go to school and become a dental tech or do something else rather than maybe working in a restaurant. So the shift in what people are doing, as well as the demographic trends, are also affecting rental markets, right? Because that really impacts it too. Where can people live? Where do they want to live? And I'll go back to Silicon Valley. That was the place to be. If you wanted to be connected, if you wanted the best job opportunities, if you wanted the best, close to the VCs and the funding, You need to be where the talent is. You need to be where the big companies is. And that's shifting as companies are not necessarily moving out of Silicon Valley, but they're opening ancillary offices in other markets, which attracts people that don't want to live in a high cost area, but diversifies their workforce. Now people have options. They can work for Google in Texas, right? They can work for Tesla in Nevada. They can work for these companies, but be in different areas. So that's actually where you see a lot of growth in new housing construction, is in these markets where people are shifting to, because it's more affordable to build. It's very expensive to build in California, and it's more affordable to build. Thus, the housing prices can be more attractive to people that are getting that salary, but also there. I apologize. That was a very long answer to a simple question, but I wanted to give a little bit of color to that. Any other questions on the economy?
Well, they're related to economy. I've got three questions on safe income, and you may want to answer these later, but I'll just give them to you now as a group. Is it safe to invest in municipal bonds or CDs? And then related question, fixed income, would you recommend right now short-term treasury bills for safety and good return?
I can answer both of those questions. First, safe investment is a very nebulous term. So I want to kind of define that for a moment. So as a fixed income investor, there's two considerations. Do you want to reach for yield, but you take a greater risk of default? And I'm being very simplistic here. There's obviously a lot of variances in this. Or are you looking for safety, which is return of your principal with a potentially lower yield? So safety means different things to different people. Is my income secure, even if there's a huge variation on price and I have some default risk? Or am I more looking at preserving this, which I know I'm going to get my principal back at maturity? Gosh darn it. So to answer the first question, the municipal space, all municipal bonds are not created equal. It's very important to either work with somebody that's skilled in this space or do a lot of research on your own, because any municipality will have different levels of quality of debt. Some will be not backed, right? Higher yielding, higher risk, potential, issues. If a state or a municipality runs into financial trouble, you could see those bonds decline in value, even if there's not a real default. Becomes an issue if you may need to get money from the source, the principal. Let's say you want to help a family member, you have a life emergency or an opportunity, and you say, oh, I'm going to sell some of my bonds. Oh no, they're down. So it's not a maturity issue, it's your needs issue. So often what makes sense in this space is, and again, this is generalized advice, please ask me specific questions to your situation. You may want to consider buckets where you have some money, and I'm using an example for representation, not a recommendation. Perhaps some is in short dated US treasuries. Okay. And that's stable. Now you could potentially, depending on how you select, get over 4% there. That would be one bucket, and that's super stable, right? Because short duration. You do have obviously rollover risk, especially if the Fed starts to drop rates and whatnot, but you have that. And maybe there's another bucket that's more intermediate, so more fluctuation in value, but a slightly higher yield. And perhaps you have another bucket that's higher yield, higher risk. You'll have to really monitor that one. And you're looking at that, and then collectively you're getting yield. So for all of you in California municipal bonds offer the benefit of a California tax-free income as well. But due to consideration is California has a massive budget shortfall projected right now, and it's likely to grow meaningfully. It's a big number. So there could be a situation where California is in a different financial position over the coming years. It's not uncommon. California is a boom and bust state. California does incredibly well when the economy is booming, and they do incredibly terribly when it's not, because of the nature of how the tax revenues come in. And so in addition, of course, people and companies moving out of state may have an impact. There's no hard data on how much impact, so there's a lot of opinions on that. But overall, going with the governor's projections, California hit a big shortfall. So do you want to say, well, with some of my money, I'm okay paying the Cal tax, I'll stick on the federal side and kind of spread out my risk, or have other state municipalities? This is really an individualized situation. Also, and I think it bears mentioning as well, is that if you shop around, you can get pretty attractive rates on money market right now. There are a lot of banks out there that are offering attractive money market rates. We're talking money market, not CDs. CDs are a bit more challenging because a lot of the CDs paying anything worth looking at have long hold periods. And that's not what you want in a rising interest rate environment. So it maybe, again, general advice here, better to have a money market that's high yield, liquid, it's flexible. You have options of FDIC insured money market at a bank. And I'm not recommending any banks. Give you an example like Capital One Bank or other banks that are saying new money, we're giving you this on your money market. And what you want to look for is it FDIC insured? Okay, if that's important to you, that money is insured, it's protected, it cannot be lost based on the FDIC insurance. And there's other options too in what's called money market mutual funds. Now, money market mutual funds are not insured. You technically have risk. During the financial crisis, some money market mutual funds, say from Lehman Brothers and other organizations, they actually broke the buck, right? They actually lost money. In that situation, the federal government was willing to come in and make investors whole. It was an extraordinary time, but there's no guarantee that would happen in the future. So do know that when you go from a money market FDIC insured bank account to a money market mutual fund, you are adding that layer of risk to that. But I would say that for your most conservative bucket, not your checking account, you're paying bills every month, but for that savings account, it may be worthwhile to look at other banks for a better interest rate, liquid, secure, and that's that. No tax advantages though, that's the one thing. And then maybe layer out those treasuries. So what makes sense, like I said, is that there's different levels of risk. One is market risk, how much that investment is likely to fluctuate day to day. And there's also default risk. Unlike stocks, generally, if a stock gets hit, goes down a lot, unless a company's in serious trouble, it will recover over time. When a bond defaults, that's it. You're getting pennies on the dollar for it. And so that's a consideration there, is that it's just a little bit different of an animal. Do you invest in the security side? Do you invest in ETFs? I'm not going to explain these because I'm sure all of you know what they are. ETFs, do you do it in a mutual fund, or do you buy the individual securities? As individual investors, buying the actual securities on your platform, like your E-Trade, Ameritrade, whatever you're using for your trading platform, it's usually not a good idea, because individual investors, because they're buying such small dollar amounts, they get what's left over. They get the stuff that the big institutions don't want. So the quality of the bond and the costs to acquire those bonds, they'll say, oh, there's no cost to it. Yes, there is, because the bond market trades very differently. There's a lot of markups there, and the smaller the investor, then the less advantageous it is to buy individual securities. If you like individual securities, a consideration may be, boy, it's very sacrilege to say this to individual investors, but it's not uncommon for someone saying, hey, I manage my stock portfolio, that's my world, I do my option strategy, I got my plan, my strategy, but my fixed income, I want individual securities, I'm going to hand this over to someone that knows what they're doing. It's perfectly fine, because most people have a strategy and an expertise focus on that, and consider that if you want individual securities, because the individual investor definitely has a disadvantage there. And a lot of times for my clients, and I'm working with very large dollars in general, I will often use a manager to acquire bonds for my clients. I pay the manager, my clients don't, because even at the size of the amount of money that I manage, I still don't have the same advantage as the super big companies. So I want to make sure my client's getting the best pricing. So that is an area that you may want to consider if you want to do individual securities, is having an outside person that's properly vetted, or company. If you do it on your own, there's advantages and disadvantages to mutual funds and to ETFs. The advantage to an ETF is you know exactly what you own. It's fixed, tends to be less costs involved at all levels. Potential tax costs, because don't forget, if your bond appreciates, that is taxable. The income isn't, but the bond appreciation is. So there are more costs in a mutual fund than with an ETF. However, there's a manager that's there, and they're watching the credit quality, and they're watching the market conditions, and they're more likely to say, oh, we don't want to own this, getting a little dicey there with the financials, sell it, buy something else. Unfortunately, if there's a tax consequence, that you will pay it. But is it better to pay a little bit of taxes and not have potentially have less default risk? So again, I always feel like I'm giving long answers to the questions, but I hope that they give enough information that everybody can glean something from that in the fixed income space. When creating your buckets, it's important to know what the intention of that money is. And that tells you the best thing. What you're going to do with the money you might need in the next year so it's very different than this is going to the kids. So that would also impact that a bit, as well as, of course, your tax bracket. For any of you that are at or near distribution stage with your retirement assets, keep a close watch on that, especially if you're hitting the RMD stage, as your taxes can be meaningfully different when that starts to happen. So look at your current tax situation, but also project out your upcoming tax situation, because small tax things can become big tax things if that changes. I'm going to pause for any questions. Any other questions on the economics?
Yes. Hi, Kristina. So we have a question about sectors. Can you talk about which sectors could possibly do well versus not so well in 2023?
I can speak at a high level. However, I have to stress what will do well or not do well in any period of time is actually not that valuable. Let me explain why. If there's a major sell-off in the tech sector, and even if the tech sector is unlikely to do well in the foreseeable future, if you have a long enough time horizon, that may be an opportunity. You're like, constantly I've heard people say, oh, I really wish I bought Amazon back in 1997. I said, yeah, you probably would have sold it. It dropped like 70% more than once. How many investors are going to hold through that much of a decline? People just throw in the towel. So if you have a long perspective, you can wait that. You still need to monitor the company and make sure its prospects are still good and not become biased, fall so in love with that company that you can't see when it's not time to own it anymore. But that long perspective means that, you know, even I say the tech sector is unlikely collectively, not all, because some companies will probably do pretty well. But it will not likely be a sector that will perform as well in 2023. If opportunity presents itself long term, you will be well rewarded. The hardest thing to do is jump off one onto the other because this is the hot thing. Okay, I'm going to ride this up, and then because it's very hard to time that from the reality of you don't know until after it's happened. You can look back and go, oh, that was a perfect time, but you don't know. And maybe it was perfect in the short term, it's terrible in the long term. So with sectors, it depends also, again, if you're being opportunistic or if you're being more cautious. Okay, so the sectors that are going to be more effective, especially later in the year, are going to be consumers. The consumer is going to become more pinched. That's going to slow down. The energy sector is great for dividends, but it's going to be quite volatile as the economy slows. So generally just the cost of energy, oil, for an example, and that will have an impact on the stock prices. Taking out any potential geopolitical risks as we've experienced over this year and the usual mechanisms of the energy market. That are you there for the dividends? Probably really secure, but will the evaluation increase? It's going to depend on factors of unknown at this point, but generally a slowing economy is going to have an impact. We're looking at China's exports just plummeting right now. Okay, China's a major buyer of energy. How will that impact the energy sector? So are you there for the dividends? Again, probably fine. I do want to timestamp this. I'm saying this on January 14th, 2023. So please know that this could change tomorrow and my guidance and views will be different. So it's very important to have, again, stay on top of these things because even a month from now, it can be very different. Healthcare sector is a pretty good area. There's two areas to consider there. One is innovation and the other one is stability. So even with the innovators, if they come up with a great idea, they'll likely be acquired at some point. But the healthcare sector is going to be probably one of the fastest growing sectors, but not in the way technology grows. It tends to be slower, but it tends to be much more meaningful over time. It also tends to be fairly recession proof, as I don't know of a single person that doesn't get the healthcare needed just because the economy is down, right? Healthcare is something that's consistent. It's largely funded by the government and by people's employers. So it also has less of an impact. For an example, the cost of healthcare is skyrocketing. Inflation is really hitting the healthcare sector. But if you're receiving, or you're on the Obamacare program, you're not feeling it because the government is subsidizing that. They're absorbing it. So that because of the government intervention in the healthcare sector, because companies' costs of healthcare is going to go up meaningfully over this next year. And some of that will be passed on to the employees, but not at the same level that the underlying inflation is. So that's, again, there's so many different areas. Infrastructure has a benefit of the government is spending a lot of money in this space. Some of it is very specific to areas of infrastructure. Some of it is more broad-based. The good thing about that is the money is already approved. It is happening. There is no question about it. Question about the economy goes in recession, question about how consumers navigate this space, question about inflation. This is already approved and passed. The other thing about infrastructure is it's pretty dang bipartisan. Yes, the Democrats and Republicans will argue about what areas are, they want to fund. Do we go towards green energy? Do we go towards the grid? But collectively, it's pretty bipartisan. And so it's unlikely to be as affected by changes in Washington as other areas is. Now, there's very careful, again, there's two different areas there. There's kind of future technologies along the renewable and green energy space. Some of that is a little bit more uncertain and speculative. And then there's the grid overall. Regardless, again, of your position on the climate and climate change and whatnot, I think we can very much agree that the infrastructure is woefully neglected. The idea that California has to turn the power off every time the wind blows means it just needs to get done. And this is not a California problem. This is not a Nevada problem. This is national. The South got really hit when their pipes froze, when they had an unseasonably cold winter storm. It's across the grid. So upgrading that infrastructure is something, again, very bipartisan, likely to have a staying power. And there's a lot of great opportunities there. And the more conservative side, there's specific areas that are great income yielders. And then the more, this is what's happening next, follow the funding, because that's, again, approved by the government. So I'm going to stop here and just check in real quick because I'm running towards the end of my time and I have not covered 2.0 yet. So perhaps I should go ahead and jump into that really quickly.
Well, so Kristina, we actually have lots of questions. I'm going to try to group these, right? So first one is on your infrastructure sector. Are there specific good ETFs to hold in that area?
Well, the regulators prohibit me giving specific investment advice in a public forum. So yes, the answer is yes, but I'm not allowed to actually say it in a public forum. This is not me. I'm not trying to be difficult. The regulators will review this webinar recording today, and I will get in trouble if I say that.
Okay, so, got it.
The short answer is yes, there are. And again, it also depends on your individual situation. Where are you? Do you have a value? Or if you're like, I really want to support renewable energy, there'd be a different place to go than, hey, I'm just looking for the best opportunities. So please reach out to myself or your advisors or your teams directly to get more specific. And again, I apologize, it's regulations.
Yep, no worries. Let me stick with some other questions around sectors. When you talk about healthcare, did you include biotech and life sciences in that, kind of sentiment?
Yes, absolutely. It's a combination of those things. And really, if you're looking for more growth as opposed to more stability, that's definitely a place to look at. And there's companies in all different stages of development. So you can decide on where you want to be on the risk profile there. But yes, most definitely, this is where the innovation is happening.
Got it. And then regarding commodities, would you recommend investing in commodities now? Or is the risk of a recession, a downtrend for that?
Whether we have a recession or an economic slowdown, which economic slowdown is already manifesting itself, commodities generally will be impacted by that. Obviously, less demand. Also, this is something it's very important to look at it at a international scale. So China is really sometimes the tail that wags the dog, just because given their size. And so if you see a global slowdown, it can impact commodity prices. So it's going to be a little more careful. But I want to say, that's buying and holding commodities. There are managed future strategies, other strategies that kind of can take either side of the trade. Commodities are a security that's traded on the long short side. So a good managed futures or commodity strategy can potentially mitigate this. But again, that's for suitable investors only. Geopolitical events are always obviously a wild card, because we never know what may happen there. So that was, again, just an overview. It really depends. What are you trying to accomplish?
Got it. And then some general tax questions. Given the US debt level and higher interest rates now, do you expect that individual income tax rates will be increased in the next few years?
It's going to depend on who controls Washington. That's going to be the big one. Because obviously there's some very different philosophies about this, but the reality is that we will experience a pretty significant economic headwind around the 2030 point. So not that far away. Can't tell you exactly when it's going to be. And that is simply, imagine the government spending as a pie chart, and 2/3 of that pie chart is the entitlement programs. Social Security, Medicare, Medicaid / Medi-Cal. And that 2/3 pie chart is growing by demographics every year, and it's squishing that 1/3. The 1/3 is stuff we all argue about politically, right? Where the government should spend their money. So that's getting squished, okay? And it's a demographics thing. And sometimes it's also government policy. For example, during the pandemic and during Obamacare, the Medicaid, Medi-Cal portion grew because of government policy. Right? They increased the number of people in these programs. So sometimes it's government policy, but even if the government did nothing and changed nothing, it's a demographic thing. We're living a lot longer and it costs us a lot more to take care of us. And that's reality. So this is going to be the greatest challenge. The government is going to have to either massively cut spending in the other areas, or they're going to need to increase revenues. There's just no way around it. I want to touch quickly upon the debt level of the government, because a lot of times people say, look at the debt level. Yes, it's massive. Yes, it's not sustainable, but the asset value of what the US holds has also risen as quickly, if not more quickly in some cases than that. So the government does technically have assets to back the debt, and because those are growing at that rate. But it is, like I said, it's a wild card, because no politician that wants to see elected office is willing to talk about, hey, we might need to make some changes. There are solutions. You could say to people in their 20s, hey, if you have a certain level of income in retirement, you're getting less. Plan accordingly. You got 40 years without destroying the system for people that depend on it. There are solutions, but the problem is the political environment is if you talk about it, you're vilified by the other side. So it makes it very hard for politicians to have that conversation. But if we don't, we will get a reckoning there. And that's going to be an issue. So in your planning, I would expect taxes will be higher in the future, as the government and states are looking for more revenues. And it's not always just the income tax levels, it's also all the other little taxes, 1% tax on wood, tax on this, a tax on that. There's little things that kind of creep in through the supply chain that ultimately pushes up costs regardless of the level of inflation. I'll touch upon that as kind of in the planning part, but I feel like I'm running out of time. Exemption, the estate tax exemption, as many of you know, is very high right now, well over 11 million. Sorry, I didn't remember this year's number because it's indexed to inflation. Well over $1.5 million for an individual, well over 22 million for a couple. That estate tax exemption has made estate planning a lot easier for the majority of people. That sunsets in 2025. So it's important to consider that in the future. Is a lot of the things you need to do from an estate planning component, if you're concerned that will sunset, it will sunset unless it gets extended, is that could drop meaningfully lower. There's been talks, the current administration, at anywhere from 3 million to 6 million. So that's a huge difference. And so it may require some estate planning around that, not to, again, this is more of an impact to the beneficiaries than it is to you yourself. So do we have more questions? Or should I just do a
we do, Kristina. and just to allay your fears, we have until 10:20, so we have lots of time to cover.
You're going to get the hook at 10 o'clock.
Act 2.0. So I love to, again,
yes, no, I'm happy to answer questions. I just want to be respectful of everyone's time here.
Thank you. Thank you. I know earlier you talked about kind of the current period and whether there's a comparable period in history similar to the current situation, of high interest rates, Fed balance sheet, high PEs. Could you maybe talk a little bit more about that?
Mm-hmm. Nothing, I say history rhymes, right? It doesn't repeat, but it rhymes. There's some similar situations, but not an exact situation. The speed in which the Fed has raised interest rates is unprecedented. So there's that. We don't have that history. The closest time period that would be somewhat close to this would be the late 70s, early 80s. During the 70s, the Fed went through very much the same process of raising rates to try to control inflation. They made a big mistake, though. They remember this mistake. They got some big memory on this, so I'm not going to do it again. They stopped too soon. said, oh, inflation's getting better. Okay, we're hurting the economy. This is not politically, whatever, pressure. We're just going to stop now. We're good. And it was too soon. And inflation they did not slay the beast, and it came roaring back. And it took Volcker in the 80s to beat the markets and the economy with a giant stick. Twice we had a recession, one after the other, to beat that down. And you saw how high rates had to get and how harsh, if for any of you that were investing during this period of time, it was brutal. And so the Fed is very clear is that they're going to get to a point where they're going to pause, and that pause is going to be long. Unless, again, they're really sure they've slayed the beast, because they don't want it coming back, because it's much harder to kill it the second time. And that's why the Fed's been running around with a giant stick in 2022. And every time the market perks up because the data looks good, the Fed's like, no, bam, 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 right? They don't want that to happen. They really want to control things to get this under control. So that would be your closest time period, but there's a lot of differences. The biggest difference is the demographics. We had a lot more working age people then paying in the system in relation to current retirees on the system. And so that demographic has shifted. So that's what's going to make this one more challenging. This recession now is likely to be short and mild and not even impact all companies or sectors. But coming up later in this decade or early in the next, it's going to be a much bigger problem. And I don't want to be the scare story, because there's a whole bunch of things that are going to happen that will make that not happen. But if trends continue, that's a high probability. It's just math. It's not, you don't have to speculate. It's just math. It's unless we have a lot of people not on the system, a lot of early deaths or something like that. If the demographics really change, maybe that would change. If government comes up with realistic policy to mitigate it, that's not destructive to those that depend on it, there could be solutions. So I don't want to scare people about the future, because it is unknown. This is a math problem that I'm watching really closely, especially for my clients that'll be living off their money during this period of time. We can't take the risk, because it could potentially be a severe recession, 5 years or more, very different than the ones we've had in recent years.
Got it. But in the current environment, you mentioned a mild recession. But even so, do you think there will be dividend cuts from good companies, particularly some of the high debt companies like AT&T?
That is a real concern. It will depend on how this, and I'm going to call it economic slowdown, because I want to predict economic slowdown or recession impacts individual companies. Will be a lot of factors. So we'll pick on AT&T here, not a recommendation to buy or sell, by the way, is that government policy and spending on telecommunications and spending on infrastructure could bolster some of the effects that they have. So there's a lot of unknowns to that, but companies that are more highly indebted, when revenues drop, you think this way, more of their revenue is being used to service debt, right? So as revenues drop, it squeezes that, which is usually not good for shareholders. So it's not necessarily a company will default on their debt, or a company is not going to be, in operation or pay their dividends. It means their margins will be squeezed. So if you're hanging out, and again, just giving an example, you're hanging out in a company for the dividend, you want to watch the financials to see how they're likely to continue to be able to pay this. And it's important to review at each earnings season. The value is less of an issue to you if you're not touching the principal. If you're looking at a total return story, you could see the returns of that company just being dragged down for the foreseeable future because of the cost of servicing the debt. So again, there's different levels. Default risk as opposed to just we have less money and it's going to pay the debt and interest on the debt.
Got it. And then let's ask one last question before we move on to the next section. Can you elaborate more on the reason for potential severe recession down the line, kind of later on this decade?
Oh, certainly. It's demographics. I mean, you saw the pie chart, and make it a slide. It's just a numbers game. It's the cost of these programs in their current form. So they're not making an assumption that they either add to the programs, put more people on the rolls. There's talks with certain people in Washington about, oh, we should start paying Social Security at 60. Right. Or we're going to enhance the benefits of this program for lower income people. So assuming none of that actually goes through and we maintain the same standards, it's a demographics thing. If we've got 10,000 people a day turning 65, and that's going to go up exponentially in the next 5 to 8 years, really exponentially. You have a lot more people on the rolls, which means the costs are higher of these programs. if you assume the tax rates stay stable, that's the pinch, right? And don't forget, when I talked about that 1/3, which is the stuff we argue about politically, there's a little sliver in there, which is interest on our debt. So for the previous 12 years, we had a U.S. Treasury had a great time. They would be able to because we're not paying off our debt. I think that ship sailed. I don't want to get any illusions here. We're not paying off our debt. So what we do is we're just refinancing, right? Treasuries mature, government issues a new one. But it's been great tailwinds for a while because they got 4, 5, 6% higher interest debt. Treasury matures, they can refi it into a 1.8. So the government was actually, it was shrinking that interest on debt, even though the debt levels were increasing, the cost to the government was shrinking. You know, that's again, cash flows going through, but that's not going to reverse, right? So now as things mature, what's happening in interest rates? They're going to refinance them at higher rates. So that little sliver of that third is growing as well. And that's just a result of, again, the Federal Reserve's actions right now with interest rates. So it is demographic. Now, again, we'll get a little bit into the political side of it too, is that the other remaining part of that sliver is something that's debated by the political parties, right? Oh, we need to spend more money here because this is really important. We need to cut taxes here. This is really important. You know, all of these are for different values and reasons and whatnot, but that's a constantly shifting thing. And it doesn't matter what the letter is after their name. All politicians want to make voters happy and get elected or reelected. So they don't usually want to tell you, hey, we're going to give you less of stuff. They want to tell you they're going to give you more of stuff. The stuff will be different if it's regarding the political party, but that's what gets you elected and reelected. So it's very hard to come to voters and say, you know what, we need to get our fiscal house in order. It's going to take a very, very powerful politician that's very able to kind of rally people together for a greater cause, which is really difficult in this highly partisan environment, to say, hey, we collectively as a country need to cut back. And I'm going to make changes that are going to affect everybody just a little bit instead of targeting one group specifically as the boogeyman. That, again, is going to take a huge political will and the right political leaders and something very different than we have today with the more hyper partisan issues. So I didn't want to come across as this is not solvable, but we're getting kind of close to the date and we're not getting in the right direction. So it's definitely bears watching. And that would really change the types of investments that you're going to want to own during this period.
Got it. Thank you, Kristina. Let's move on to your next section, and then we'll come back to more market questions.
Okay. For this section, why I'm wearing my glasses is because I'm going to be 54 here, and wow, by the end of this month, and my near vision is not super good. So I'm going to have to read some of these things off of this, and I'm going to cover this very quickly. The Secure Act 2.0 was massive. There's so much stuff in there that it would take me an hour just to go over it all. So I'm going to kind of touch upon high level considerations, a couple of interesting things, but I do want to stress is that either reach out to me or do your own research. The information is readily available. Avoid research where it's telling you how to strategize around these things, only from the standpoint is what you should do depends on your situation. It is not a one size fits all. One size fits all is pay your taxes on time. Everything else is really depends. For an example, sometimes people say, oh, I'm going to do this to save on taxes. But in the future, your tax bill will be much higher. An example of that is the first topic I'll talk about, which again, many of you may know this. I'm going to cover this quickly and ask questions. So RMDs, for those of you that are of a certain age or aware of this, the current law of required minimum distributions from your IRA or any retirement accounts, excluding Roths, with the exception of your current employer, you're required to take a minimum distribution. The distribution amount is based on your age and other factors. So the current law is it's age 72. Well, they're going to give a little window and it's going to hop up to age 73. For people born in 1960 or later, it's actually going to go to age 75. So on a high level, that's great for people that they're like, why do I have to take this money out and pay the government taxes? I'm still working, gosh darn it, I don't need this money. And a lot of strategies that are involved around that. However, it may not always be the right thing to do because what you don't want to do is hit that giant tax crunch. So, okay, I'm deferring, and all of a sudden you hit 73 or 75 and it's like, oh, I have to take how much out? Because many people, their biggest savings is in those tax deferred IRA/401k 403b accounts. It's not always a good thing to not pay taxes now and pay massive tax in the future. So this is where financial strategy is going to be really important. where are you drawing the money from and how much do you need, so you can minimize taxes over the entirety of your lifespan, not just in the immediate future. So that's really important. Another one too is inherited IRAs by spouse. It's really nice to know now if you're married or in a relationship and again, you're married and your spouse passes, your RMDs are based on your age, not on theirs. So that really helps a lot with times when people were required to. And again, there's a lot of nuances, there's a lot of details. So just keep in mind the rules around inherited IRAs have changed meaningfully. So if you're inheriting an IRA from a spouse or inheriting an IRA from another family member, it's important to understand these change in rules and how this may affect you, because there's tremendous room to optimize taxes and strategy in this space. Lots of changes. Literally, you should see my flow chart on inherited IRAs. It used to be simple. It's not simple anymore. So it's something you really want to research before making an election of how you're going to take distributions. Really big one. Another one too, is nice is for those of you that are able to do so or want to do so, the ability to make charitable contributions from your IRA, your RMDs. That's not going away. I think it's up to 100,000 a year. You can transfer out of the IRAs into a qualified charity, which is really helpful if you are already charitably inclined. You don't need this money and you don't want to be in that high tax bracket because you don't want to kick a lot of extra money. Your ability to give effectively through this mechanism is only increased, not decreased. There's a lot of things to company retirement plans. I'm going to skip past a lot of that today, but I'll touch upon the high level. One of the really biggies here is that if your company has a Roth option and you are making more than $145,000 a year, and you're over 50, you're required to do your catch-up contributions, the extra that you could put in once you're over 50, you're required to put those in the Roth side. Okay, this is a biggie. Okay, so in the past, people say, oh, this is great, I can put more money aside. If you're over the 145,000 level and your company offers a Roth, if they don't offer a Roth option, don't have to do it. But if they offer a Roth option, that catch-up contribution goes into the Roth side of things. There's a lot of cool strategies to mitigate that if you choose to do so, especially if you're changing jobs or retiring during this period of time. How you put money in various 401ks can eliminate this concern. Again, there's so many options around these things. I want to make sure you know this is a planning thing rather than a, oh my gosh, a thing, because almost every single one of these, there's kind of workarounds if it's going to be onerous to your financial situation. So I want to bring that one up. Also, there's a lot of things. Again, I probably should skip past all the retirement things because I don't know everybody's life stage right now, but you can ask me questions on that. Something that a lot of questions that come across is the ability to move money from from a Roth account to a 529 plan, or from a 529, went backwards, 529 plan to a Roth account. So sometimes the concern with people is I'm putting all this money in my kid's 529 plan and they didn't use it all. And there's no more kids to transfer it to. And they don't need it. They got a scholarship. I have extra money in this account. What do I do now? There is a clause in there that allows you to transfer some of that money into a Roth account for the beneficiary. So let's say you got Sally, she got a scholarship, she's got money left in her account, and you say, Sally, you know what would be the greatest thing for your financial future? We're gonna open a Roth, right? And put the money in there. And then that grows tax-free. Wow, pretty cool, huh? Huge limitations to it, huge restrictions. They have to be open for 15 years. It has to be the same beneficiary. The dollar amount you can put in is really limited. I think $35,000 is the max in a lifetime. So it all helps. If you don't know, I'll tell you for sure, the greatest gift you can give to your kids is helping them set up a Roth, because they got all those years of tax-free growth, right? Tax-free growth for the future. And in addition to that, I want to add one more thing to the beneficiary thing. They also have to be earning an income. So they have to be an income earner. So it's all the same rules to Roth supply. A lot of nuances to that rule. So don't get too excited to look at the details, which brings me to the comment about taking money, your charitable contribution, moving it into your CRT or CRUT or any other, tax deferred vehicle, or sorry, out of the state tax-free vehicle that goes to charity upon your passing. A whole nother webinar on estate planning on this. It doesn't often make sense because of a lot of limitations around that. I would say if you're looking to optimize that, I can't stress enough to do a solid financial plan, because there's so many nuances to it. That I'm looking at for clients, and like most all the time, it doesn't make any sense. So it's available, but is that the right thing to do? Probably not, but it does depend on your situation and what are the resources and options that you have there. All right, I'm gonna jump back and forth to the notes here. Distributions, what we call like emergency distributions, or during premature distributions from retirement accounts. I'll talk a bit about that because that was expanded a bit and it's sort of important here. So as many of you know, if you take money out of your retirement account, your IRA, your 401k from a previous employer, when your employee is in the story, there is penalty of 10% in addition to the taxes for taking the money out before age 59 and a half. That has not changed. However, there's exceptions here. So some of these exceptions are areas, for an example, like, well, I'll tell you, victims of domestic violence, for first responders, for various, a terminal illness. And terminal illness is actually defined as a doctor certifies you're likely to die within 8 years. Very liberal definition there. A big one now, consideration, I've done this for a couple of people, has been around disaster relief. So if your area is determined as a federal disaster zone or certified disaster zone, you have the ability to pull money out of your retirement accounts for that purpose without penalty. Still have to pay the taxes. However, it's not a large sum. I apologize. I think it's around 22,000 or so. It's not big numbers. So yes, you could probably fix your fence, but probably not replace your house. And yes, you can do these things, but does it make sense? I'm going to kind of jump over, because in the interest of time, to the planning side. You are taking from your future for the present. Is that the best course of action? That's going to depend on your situation. Do you have other options? Do you have other resources? Is this the right thing to do? And which is why I'm going to obviously, there's tons of information here on this. I stress to talk to me specifically about any of these that I'm going over too quickly. So I'll skip past the emergency savings, all the corporate plan things. The penalties on RMDs that are not taken. So if you forget to take your RMD because you got that 401k account up there from an old employer and you totally space it out and you didn't take the RMD, and previously that was a 50% loss to the IRS penalty, 50%. They've dropped that down to 25%, and there's a course of mitigating it, for fixing the problem. They give it a little bit of wiggle room there. So there's a lot less of onerous hit if you forget to take your RMDs. The other one, a final one I'm going to talk about, because again, I don't know everybody's employment status, is if you have a solo or an individual 401k, you are now, previously you had to make all your contributions in that calendar year. They now are extending that to be in line with IRAs and SEPs, that you have up to the tax filing date, not extensions. So that is really helpful for someone that's trying to make the decision how much to put in their solo 401k. Now they can kind of get a better sense of their tax picture and make that determination up to tax due date. So I'm going to stop there. Again, there's so much information. I went fast on this. There's a lot more to it, a lot of nuances, and jump quickly into the financial planning side of things. On a very high level, as I mentioned earlier, your situation is very individual. What is a brilliant idea for one person could be completely devastating for you. And the biggest mistake I see people making in financial planning is looking at areas of their financial life in isolation, looking at the investment returns of the portfolio as the focus, looking at taxes as the focus, or looking at anything as a focus separately from the collective whole. Truly holistically looking at everything and how it interacts is critical. Saving taxes today could really kill you in the future. A lot of people are finding that out. They retire and all their money's in tax deferred vehicles. And they go, oh my gosh, I have to pay how much of this to the government? Wait, I thought I had this much, but I really only have this much. Yikes, right? And that's a big thing that comes up in financial planning is, you're thinking of short-term tax advantages, not really thinking of long-term strategy. Things like Roth conversions or series of distributions, which accounts you take money from. Sometimes in planning, you can get someone $100,000 of income at a $25,000 income tax bracket. How are you taking that money? You can also get somebody $100,000 of income, and you're going to be at the worst state that you could possibly be in. So the buckets that you establish during your working years, during your pre-retirement years, will set the foundation for your success long-term, which is everyone's goal, is don't run out of money. Make sure what's most important and valuable to you in your lifetime is what's being accomplished. And also beyond your lifetime, if that's your focus as well. So look at things collectively, holistically. It may be worth hiring a financial planner that works on a fee only basis. This is important because if you are individual investors, many people want you to have them manage your investments. And maybe that's something you're open to doing. But a lot of companies, they're compensated on you giving them your assets. So if you like to do it yourself, seek out a financial planner that you pay a flat fee for service, and they will do specifically what it is you've hired them to do. We do that at Sequoia. I'm not trying in any way to sit here and promote Sequoia or solicit your business. I want to make sure you're aware of it. There are other firms that do this as well. So the conversation is, I just need a financial plan. And even if you're already doing a plan, it's great to have another set of eyes to make sure there's no blind spots or anything you missed. It's really worth doing. Some of the most valuable money I spent in the past was hiring an attorney to review a lease agreement that I was going to sign. And I'm a pretty knowledgeable person when it comes to contracts, but man, oh man, it was worth paying that attorney because he found a whole lot of stuff in there that was not going to be good for me, really good for the landlord. So sometimes it's good to have another set of eyes. And again, just seek out a firm or an individual that does the planning and is qualified to do so. You can do it once and be done. You bet, hey, check it out. Tell me where I'm missing it. I'm going to go do this on my own. Or you can say, you know what, I'm going to have kind of work with a team here, even if I'm doing my investments. Yeah, not saying that's right for you, but as a consideration, if any of this was like, a lot of stuff going on. The purpose of doing this, the planning, is to your highest probability of achieving what it is that you're set out to do. Whatever your personal goals are, your goals for your community, your goals in your lifetime and beyond. How much can you help your children? How much can you give to charity? How can you be sure you're going to be okay? Because the big wild card is few of us know how long we have to live. Very few of us. So longevity is the biggest risk. When you're doing your planning, what you want to consider is, think of it this is so simplistic. And it could be different in different portfolios or different savings vehicles, not just portfolios, real estate, savings accounts, etc. Is you're in a stage in your life when you're in the accumulation phase. This is a point when you're looking at long-term growth and you want to be more opportunistic. You're putting money in, no need for it for the foreseeable future. This is not based on age, because I have a lot of clients that are in their 70s and have accumulation accounts because it's going to grandkids, right? So it's a time horizon of when that money is needed that determines the strategy. And so you're in that accumulation phase. You want to take advantage of getting money in at the right time. Investment mix, long-term goal, very different. Then as you get closer to when you're going to start to take funds, you go more into the preservation stage. Again, not with all your accounts necessarily. You may have, hey, let the Roth grow. This is the bucket I'm going to be using short term. Preservation is not running for the hills in cash. It's figuring out, okay, what exactly is this portfolio supposed to do? And when is it supposed to do it? What are the best types of securities to have in it? There's other layers there, obviously economic conditions, company prospects, tax considerations, all of these things matter, but that time horizon, preservation. And then the other one is longevity. I do not want to run out of this money, whether I want to travel the world or help my kids, help society. I don't want to run out because I don't want to be eating the cat food in retirement. That's key. And that's the thing that no matter how many zeros are on accounts, imagine how much the net worth of the client is. That is a concern about just about everybody, except for people that truly have nothing saved and they just don't care for a dollar, right? So this is important consideration. So not seeing things in isolation and seeing things holistically and long-term is really, really important. And sometimes we do a lot of tax strategy and I'll review a tax return. I'm like, oh, if you do like these 3 things, you're going to save a whole bunch of money on taxes. So it's like, really? And I'm like, yeah, and that's risk-free return. And I don't get to say that in the investment world. Right? That mattered, right? And you know what you're going to get. You do these 3 things, you're going to get this unless they change the tax law. That's huge. That's money in your pocket. So let me stop here. I know I'm coming up against time. Questions?
So thank you, Kristina, for covering such a wide variety of topics today. Maybe we have one question just to round that out. Can you comment on the global economy as compared to the US? How do international equity and fixed income investments look to you right now?
Fixed income very much depends on the credit quality of the underlying companies, same as US, and also the other layer of geopolitical risk. Okay, different countries have different levels of stability in their financial systems. Some countries have a lot more government control, other ones are more free market, and where they are in the cycle. So Europe will likely be emerging from their recession. I'm not saying necessarily when the US goes into theirs, but they're already there, not all of Europe, but a lot of it. They'll likely come out beforehand. So it's very individualistic to specific countries. You do have always the geopolitical risk. For an example, the US is very actively trying to onshore. This is on a government policy level as well as a corporate policy level. We're seeing massive onshoring. There's government incentives to bring things back to the United States or to other countries that are seen as more friendly than China. That's going to be huge. We just saw, I said, China's export data. Wow, they're getting hit. A lot moving out of that country. Why? China's not seen as a stable place. They're not seen as a stable place because the government has total control over the markets. The government is more than happy to steal ideas. Not the government, but it's more allowable companies to poach ideas. So there's that risk there as well. And they're required to share a lot in order to do business in China. The COVID lockdowns, the zero COVID policy was a big deal because it disrupted supply chain of a country, of companies all over the world, because it's all in China. Now there's lockdown, right? We don't get our parts. We can't get an iPhone made. We can't get a Tesla made, whatever it is, right? So the supply chain disruptions around COVID were extended out of China. So there's a national security risk of things being in China, but there's also economic risk because of those factors. So that area is a little bit dicey. I'm not saying don't invest in that space, but you have to know that the government can come in any time and go, we're changing the rules. So that's a geopolitical economic risk. Obviously, we have conflict. So the conflict in Russia and Ukraine, I'm not even going to remotely predict how that one's going to end, but it's probably going to go on for a while. Neither side's, as long as the US continues to fund, US and Europe continues to fund Ukraine with weapons and research and whatnot, and as long as Russia wants to fight this war, it's probably going to keep going on. At some point, anyway, does this war extend into a greater war? Again, not my area of expertise, so I'm not going to predict it, but that's a way where you could actually see the economic picture change very quickly. On the other hand, there's a lot of countries that are actually doing really well. They're going to have fits and starts. It's not going to be smooth and easy, but you look at India. India's eclipsing China in population, and India has a lot of educated workforce. Not enough, unfortunately. They got a ways to go there. If they can get more education in the workforce, they're going to be a big contender in the future. But India is actually doing pretty well in many areas. Okay, and again, this is not an investment recommendation because there's always concerns there, but they have more of a democratic society than China does. So a little bit more market stability there. So that was, again, a long way of saying, know the country, know the country's risk, and know the companies you're investing in, because just because a company is a German company or a Chinese company or anything else, it's not where it's domiciled, it's where they get their revenue from. So if you have a US-based company and the US is pumping along fine their economy and Europe's going into recession, you want to know where's the revenue coming from. If this company is largely selling to Europe, they're going to be more impacted than a European country that's largely selling to the US. So I hope that makes sense. It's not domiciled, it's where the revenue comes from.
So we have reached the end of the time for this session. Lynn, would you like to wrap up?
Yes, thank you very much, Kristina, for excellent and wide-ranging coverage of the economy and the issues that are going on right now. We'll take a 5-minute break, and thank you all.
Everyone. Have a wonderful weekend.